All right, Bish, welcome. Let's get right into it. There's lots happening in macro. There's lots happening geopolitically. There's lots happening with Bitcoin and markets. So let's skip the platitudes and let's get right into it. Give the audience an update. Have you seen the world?
Mate, well, first of all, it's a great way to get stuck straight into things because the markets have been moving around like craziness. We've seen oil, gold, silver trading like low cap shit coins over the last little while. So, and these are massive global macro asset classes. So, yeah, definitely skipping the platitudes on this one. So, obviously, oil hitting 120 was a bit of a watershed moment, but it was funny. I was on a live stream with one of the commentators I work with. He's really big on commodities, and there was a lot of people on that live stream going, oil 150, oil 200. And I said, all it takes is one post from old Trumpy to go out and say that this war is over, to, because he can't afford to have $4, $5 a gallon gas at the station, because it's just going to completely destroy his midterms. And then lo and behold, 24 hours later, the Trump post came out. Boom, market went down 40% almost in the 24-hour stretch. We've now since recovered, but we have to keep in mind that with oil trading the way it is, it's not benefiting Trump's twofold agenda, which is one, secure the midterms, and two, ensure that they can drive yields lower so that they can refinance $15 trillion worth of national debt at much more manageable interest rates.
And just for those out there, yields, when Bish refers to yields, he's primarily talking about the US 10-year yield, which is the rate that the government has to borrow at, and the coupon that they have to pay on that money borrowed. So institutions and funds, etc., they lend money to the government. The government has to pay interest on that. And historically, what you've seen is oil and the 10-year, they usually move in correlation. So if oil is going up, the yield is going up, which means the interest that the government has to pay is going up. And to your point, that's not what the government wants, especially now.
Yeah, and we've also seen the US 2-year yield and the US 10-year yield starting to flatten, which shows me that there is more likely inflation risks being priced into the bond market rather than a recession risk. A lot of the time, a few months ago, people were worried about recessions blowing out and that, we doom and doom and doom around the AI redundancies that were happening, and that people were saying that this is the start of a massive economic downturn. But obviously with all of the conflict going on in Iran and in the Middle East right now, there's actually greater risks of inflation, and a greater risk of inflation and currency printing going on is actually going to show up in Bitcoin with relative strength.
And the gap between the 2-year yield and the 10-year yield flattening means it's coming closer together, and like a really, really dirty way, because liquidity is kind of like a pseudoscience depending on who you ask, but a really, really dirty way to kind of gauge whether liquidity is contracting or expanding is the gap between the 10-year and the 2-year. If that's flattening, liquidity is coming out of the market. If it's widening, if it's deepening, then liquidity into the market. So that is something to consider as well.
Yeah, 100%. And then further to that, we've seen the commodities, the precious metals complex continue to do quite well. Gold is now, stabilizing over 5,000. Silver, despite its recent correction, is trading in the mid 80s. And we're starting to see things like copper, which historically underperforms during periods of economic contraction. It's known as Dr. Copper. Whenever we see copper prices coming down, there's usually an expectation that economic slowdown is coming through. With copper prices ripping higher, what we're actually facing is a structural inflationary regime, which is antithetical towards a recession, deep correction type of regime. With that said, though, that does still provide and present a lot of risk to Bitcoin, because if the inflation gets out of control, it's likely that the Federal Reserve will have to increase rates, lift rates up, which then sucks liquidity out of the system, which Bitcoin has historically benefited from.
Just on that rates point, and I'll get we will talk about we will talk about our receipts from the last episode and what came true and what didn't, and we'll also give our predictions for what we think is going to happen moving forward with relation to Bitcoin. But I do want to get your predictions on macro. We've touched on oil, gold, etc., and I want to get your what you think is going to unfold, how you think assets which is going to go up, which is going to go down, what's going to happen over the next 1 month, 3 months, and 6 months. But just in relation to the interest rates that you just mentioned, I get an update from Westpac, and I get this daily update each and every day, and they're basically reporting that the RBA is to hike in March, followed by another hike in May. So that is basically echoing exactly what you're saying, that we're in a structurally inflationary regime, and that's going to mean higher interest rates, right? And that does bring with it some potential economic slowdown issues. But yeah, how do you see it all unfolding at the moment? What's your view?
Look, to really break it down, Mark, the way I see a hiking of interest rates, it's going to hurt Aussies more than it is going to hurt Bitcoin. I'm talking about everyday mortgaged Australians, because I have been a giga bear on the Australian housing market for quite some time now. But I haven't expressed that position by anything other than just getting long and strong on Bitcoin. That's not to say that it's going to be, doom and gloom and you're just going to get Aussie property to zero. It's like I don't ever operate in the extremes. I just think that when you start seeing that a lot of millennials, Gen Z, a lot of younger, hardworking Aussies are priced out of the housing market, but if you've got steepening and climbing interest rates, and you've got the Australian housing market is now massively leveraged because they've dropped the capital deposit requirements from a 10% deposit requirement down to 5% deposit requirement. Single mothers could apply to have a 2% deposit requirement, which is we've created a bit of our own subprime mortgage crisis here in Australia. We didn't get to experience the depth of that during 2008 GFC. We've kind of replicated that recently, and you would have probably seen from a number of the big four banks, they had written over $1 billion worth of fraudulent loans because of AI pay slips being put through, and CBA called in the cops on themselves, and Lord knows what else has happened. But the Australian housing market is pretty much propped up by a lot of bad debt and a lot of toxic leverage. And if that leverage can no longer be serviced, and if that debt can no longer be serviced, and people are wanting to offload properties in order to, in order to, no longer have an asset that they're bleeding on, who's going to buy it? Who's going to buy it? Right. And this is where you're starting to see even credit, cracks in the private credit market, which has historically where a lot of people who couldn't get bank lending previously go towards the private credit markets to go get their home loans and whatnot. You would have seen, things like Blackstone trading down massively, getting absolutely hammered in the US public markets because of their private credit funds freezing redemptions. Right? Or freezing redemptions up to 5% of value, right? Because they're experiencing their own liquidity constraints. So when you combine a rising interest rate environment, mortgages that people can no longer afford, houses that usually who would be able to receive them no longer being able to afford them, cracks in the private credit market, you're most likely going to see in the residential property sector a pretty big correction. And unfortunately in Australia, because we're so levered and exposed to the Australian property market, that will hurt us a lot more than it can hurt Bitcoin, because whilst that liquidity contraction in Australia will affect everyday Aussies, we're not really the global liquidity profile. Like when we're talking about liquidity, we're usually talking about American liquidity, because that's what really sets the price for assets downstream, particularly out of the US bond market. So if we're experiencing that, that's where I feel like if we can get some liquidity out of the housing market now, and you can get your house on, and you can get someone to bid it up and buy your asset and take that stress off your hands, then that's good. But it's different if you're unencumbered and you're in a different situation. So this is obviously not financial advice. It just depends on how you're structured, how you're exposed to that debt. Are you in a position to service it? If you're not in a position to service it and the rates are going to continue to lift, then you're really going to struggle. So for me, it's like I value freedom, liquidity, and the ability to access my own capital on my own terms at all times. That's why I'm mainly exposed to Bitcoin. But again, if you've got a really good venue, a really good site, you're either you're unencumbered or you're developing, it's very different than if you're just living in your house that you owe a boatload of cash on, and interest rates start to rise. You can probably feel the pinch there. we had to actually stop. There was actually almost a Senate inquiry into the RBA as to why they lifted rates so aggressively when they said they weren't going to be lifting rates in 2021. So, it was on record that the governor at the time came out and said, we're not going to be raising interest rates anytime soon. And then in 2022, went on the fastest interest rate hike in recorded history, right? At least here in Australia. So we have to be really careful with how we are exposed to leverage and debt during this massive debt reset that we're seeing. So it's not financial advice, but it's just about keeping in mind where you're exposed to credit and leverage.
All right, it's time to take money, markets, and mayhem to the next level. The number one way that I think I can do that is to bring the most credible, the most experienced, and the most knowledgeable macro voices in the world on the show, to interview them, to get them to cut through the noise and give you the most deliverable, executable, and actionable things that you need to know in today's markets. In order for me to do that, I just need one small favor from you. I need you to go below and hit the subscribe button. As crazy as it sounds, the more subscribers, the more guests are willing to come on the show. I've got so much to say on that, and I'll try and keep it simple. But my view on property, and I've been saying this since I launched the Money Markets and Mayhem channel, is that over the next 5, 10, 15 years, gold and Bitcoin will outperform property, especially Australian property. And reasons for that is part of what you've just outlined. And on top of that, the fact that the government uses property as a tax coup for them, right? And they're continuing to increase the taxes. And, contrary to popular belief, property can be stolen through taxes and various different law changes and things like that. But what I believe, even if over that same period, property doesn't go backwards and it keeps rising, it won't rise as much as money put into the system. So it'll at best keep up with the amount of money that's put into the system or the debt that's created. But it has a bunch of other structural headwinds that could hit it at any time. And I think one of the reasons, because everybody from overseas always talks about the reckoning that Australian property prices are going to have, and to date it hasn't had it. Right? And if you ask me, the reason that we haven't had that reckoning here is because there has not been the political will to allow it to happen. So the people in power own too much property, and the largest voter bases, which has been the boomers, own too much property. So the will to allow the market to correct, it hasn't been there. But there's a bunch of different things that are happening that at some point you might reach a tipping point and that correction is allowed to happen. You've got AI, and that feeds into the debt issue. If all of a sudden AI quickly wipes out a lot of jobs, right? I don't think it'll wipe out jobs over the long term. I think it'll create them. But if there's a transition period where a lot of the unemployment rises, unemployed people can't pay their mortgages. That puts pressure, all right? You've got 3D printed homes. Again, that technology is available. I think you would see more of it if there was a political will, right? Because obviously that's going to bring the cost of house prices down. But it's a headwind that we need to consider that Bitcoin doesn't have. Bitcoin, scarce amount of supply, etc. You can't deflate it. You've got, and I think this is the biggest one, you've got the millennials coming of age, and once they become the largest cohort and the boomers die off, the political will can change. Because if the ones that are voting don't have property, it's easy to see capital gains tax abolished. It's easy to see pro 3D printed houses, etc. come in. And so there is going to be, I do think eventually there will be that reckoning, even though I feel like over the next 10, 15 years, property prices will still go up. On real terms versus gold and Bitcoin, they'll get killed, right? And I couldn't agree with you more that as so many Australians have had property as a pastime and have amassed large parcels of property, they need to start considering diversifying out of that potentially, right? In my opinion. And there was a guy, I think Albert Fugel or whatever his name was, way back, came up with the 100-year portfolio, right? And it's a portfolio to outlast all of these things that we're discussing that happen over generational cycles. And he basically said you go 25% property, 25% gold, 25% blue chip stocks, 25% cash to buy the dip, and you rebalance, right? But the reality is, like, even if you don't go all in Bitcoin, gold, whatever, if more people had something adjacent to that, they would be better off. But the majority of people in this country are 90 to 100% property, right? Or if they've got something else, it's super as a 10, 20% in super, right?
Which is just bonds and stocks anyway.
Which is bonds and stocks, and the ones that we think might be a little bit more in trouble. So it is a conversation that I think is on the fringe at the moment. It's mainly just guys like us or Bitcoin nerds that are talking about it. But this affects the whole boomer population, right? Anyone that currently owns a lot of housing, and the kids out there that don't and own Bitcoin, they're probably just saying, "Shut up, Mark. Let it happen. Let it happen." But people often, and I want to get your thoughts on this. People ask me about tokenized real estate, and I just say, well, what's the point? Like, what's the point of owning $10,000 worth of real estate that we've already discussed these headwinds for, when you can put that $10,000 into Bitcoin or Ethereum, or choose your next AI stock of choice, right? It doesn't make sense for me.
Yeah, I mean, look, on the topic of tokenization, like this is a mega trend that we do need to get on top of, and I'm glad that you brought it up. Obviously, you can tokenize real estate, precious metals, you can tokenize commodities, but to what end, right? Which is what I agree with you on. Like, if are we going to tokenize Toowoomban real estate? Are we going to be tokenizing far north Queensland real estate? Like, usually it'll be more like large scale developments that people can get access to, for example.
Substitution for syndication, right?
Yeah. So that would make a lot of sense for something like that. But I'm mega bullish on tokenization. We've seen it with the impact of the Iran conflict right now, where oil prices were genuinely being price discovered on Hyperliquid. It's insanity to look at it, and people go out there and are saying crypto's dead, right? And they honestly look me in the eye and say crypto is dead, Mark, when the world's largest hedge fund managers, risk managers, oil producers are using Hyperliquid in order to hedge their risk and manage overnight their exposures towards the oil market, which has been whipsawing around like no tomorrow. Oil went through genuine price discovery on Hyperliquid. And I cannot stress the importance of crypto infrastructure becoming the financial infrastructure, right? NASDAQ is now in talks with Kraken to offer 24/7 equities trading. Equities are going to become tokenized. Bonds are going to become tokenized. Financial contracts of all description will become tokenized and trade 24/7, 365, so that people can manage their risk. Because Trump has always made all of his moves throughout his entire administration on Friday night, Saturday morning our time, when markets are closed. All the Trump tariff tweets, all the aggressive rhetoric, all the military action against Venezuela, against Iran has occurred Friday night and US Saturday morning our time. Why? Because he wants to be able to do it quick on the weekend and have the financial markets unaffected. But thanks to crypto, thanks to actual venues that allow us to manage and trade our risk properly 24/7, 365, and Bitcoin initially on the onset of the conflict traded down to 63, now trading at 70, shows me everything that people need to understand about where the state of crypto is right now, which is the biggest gap between the reality and the sentiment. The reality is we are becoming genuine financial infrastructure. The sentiment is crypto is dead. It's never coming back. It's never going to pump because of the depressed token prices. That, my dear friends, that gap between reality and where the sentiment is where maximum financial opportunity is found. I could not be more bullish because of that gap. Now, could we go a little bit lower? Could we swing to 50s? Possibly, yeah. I'm not saying that we're out of the woods, but that gap between how tokenized assets have traded, how Hyperliquid has operated, how Bitcoin responded in the conflict, and where the sentiment is, that's juicy.
Can you give the audience an explanation of what Hyperliquid is? Because Hyperliquid is a crypto platform. It has a token. It's been one of the better performing altcoin tokens. And I don't know if you guys could see it, but I popped up the screenshot that they had 10x the trading volume that Coinbase had on oil futures when the conflict broke out. And this is something that is extremely important. We are definitely moving towards a world where markets will operate 24/7. And like you said, Trump is always doing these geopolitical moves on the weekends when markets are closed. And these big funds need to be able to hedge their risk when this kind of shit unfolds. And they're turning to these 24/7 crypto platforms to do that. So explain Hyperliquid. And, you said to me off air that you're bullish on Hyperliquid. Tell me why.
So Hyperliquid in simple terms is a decentralized exchange, which means that it doesn't require KYC to trade on. It's just a protocol, right? It allows you to deposit in things like USDC or USDT to fund your account. And then you get access to a couple of spot markets, but mainly what is known as perpetuals or futures, where you can trade all manner of synthetic exposure towards gold, silver, copper, oil is all on there now. There's also TradFi markets such as NASDAQ and other, the S&P 500, as well as individual stocks such as Tesla, Apple, Nvidia can all be traded on Hyperliquid in real time. The key difference though is that it's synthetic exposure, right? You do not own the underlying asset when you're going long or short on these platforms. Think of it as like a contract for difference, where you can trade as many instruments as you want via a synthetic exposure.
Is it a token? Would you consider it tokenized, or it's not quite?
It's not quite tokenized. When I think of tokenized, I think of
They're holding the asset.
Yeah, there's an underlying claim. So
Yeah.
to whatever it is. So if there's genuine tokenized gold vis-a-vis Pax Gold, which we support here at Stormbreaker, to be purchased, each token that sits on the Ethereum blockchain, one Pax Gold token, is represented by 1 ounce of gold sitting in a London vault, right? So it's 1-for-1 backed. Whereas this is, I think of it as more of a futures contract, a CFD. It's more of a perpetual swap. It's just a derivative that you can have to give you exposure to the price, either long or short. You can trade 1-for-1 in the sense that you trade without leverage. So you put in $10,000 and you can only buy $10,000 worth of oil contracts. So you're unleveraged in that sense. You can still lose a lot if you get it wrong, but that's how that platform works. And it's fascinating to see the success of it because it reflects quite well on the HYPE token, because Hyperliquid as a platform has a buyback and burn program, which is based off the revenues that the protocol generates. They buy back their own token from the open market and then burn it so that the supply gets reduced. So that's a positive protocol practice that allows the success and the revenues, whilst it's not directly, you're not partaking, it's not like a stock where you have a claim on the future profits of the business via a dividend, but it's similar in partaking in the revenue success of that protocol because they buy back the HYPE token and then burn, so therefore reducing the supply. So there's two positive dynamics there. They buy it from the open market, which lifts the price, and then they reduce the long-term supply, which is long-term bullish because it becomes deflationary over time.
So in simple terms, how does value accrue to the token? Because my understanding was that the fees that they make also accrue to the token. Can you just explain it in simple terms one more time?
So the fees that are generated on the protocol, which is known as Hyperliquid, go towards buying back its own token from the open market. And then once they've bought it, they burn those tokens by sending it to a burn address, which reduces the supply of overall available Hyperliquid to be traded.
And guys, if you just want to have a quick look at in a market that has largely been a down market for crypto, if you want, this is the weekly chart of the HYPE token. So it's only been around since December 2024. It ran up to $50-$60 September 2025 before everything started selling off. But if you look at it in the last couple of weeks, it's been very strong. And in the last week, especially when all this oil stuff was happening with the Iran war, it's had a monster week, right? It's up 20% in the last week. So this is This just goes to show you the need for these kind of 24/7 tools, right? It has been slower than crypto people have thought that it would unfold, but these kind of use cases, they do exist, right? There is a use case for these kind of platforms, and you can see that that's been reflected in the price of the token recently. So, yeah, that's a strong one.
And the thing is that this is where it's that technology, the fusion curve, right, as to how adoption occurs over time. Plus, there's this adoption curve that all technology goes through, which is like this slope of delusion that it goes through. That when we said us crypto bros, crypto is going to take over the world. Everything's going to get tokenized. You're going to be able to trade, 24/7, and it's Bitcoin's going to become the base money of the world. That was true. That was true. But then what happens is that there's a trough of disillusionment as well, which is, we ended up with cat coins and dog coins and meme coins, and we were trading Venezuela token and Argentina token, and there was all of these scam pump and dumps that occurred in the Solana trenches, and then prior to that the NFTs, and then prior to that the ICO scams that occurred in 2017. So when the liquidity conditions got frothy, all of a sudden, all of the genuine real use case was washed out with all of the froth, all of the pump and dumps, all of the scams that had just extracted liquidity and value from the ecosystem. Now that that's been completely, like, there has been a ravaging of those kind of garbage tokens, down 90%, 99%, completely just destroyed, wiped out. You're left with value. Where does the value, like, what is it that we're actually proposing here? As a crypto bro, as a big Bitcoiner, what am I proposing here? I'm proposing Bitcoin as a base money, and that there'll be protocols and technologies like Hyperliquid, Ethereum, Solana, which will allow us to manage and mitigate financial risk 24/7, 365, and you can cross-collateralize. So, for example, I can trade on Phantom using Solana as collateral, but I can get exposure to silver when the market was closed, the futures market was closed. So all of these things works in our advantage, and that's where the value will accrue to over time. So now that the garbage has been eradicated, we're now starting to see genuine value accrue to protocols and tokens that are delivering on that promise that we stated all those years ago. So that, again, brings me back to the gap between what we're delivering on is quite high, and the reality of the crypto markets have never been stronger in terms of the fundamentals, but the sentiment and the technicals and the charts still look absolutely garbage. So that gap is where the value is found.
I agree. I couldn't agree more. And there is a case, and the diehard Bitcoin maximalists will tell you that eventually Bitcoin will be the base layer of the financial system, and that is the extreme bullish tale, right? But for Bitcoin to go to $1 million, we don't need to reach that extreme, right? It can still get to $1 million even if fiat remains, etc. Because what you're starting to see, right? And I want to ask you about stablecoins, because I think stablecoins are the Trojan horse. I think my opinion is the US government, the military, etc., are all looking at stablecoins as a little bit of a statecraft tactic in order to keep the USD as the global reserve currency, and I believe they're going to try and use stablecoins to do that. I would recommend everyone go out there and have a look at the Genius Act that was passed by the US government, and the Clarity Act that is now Polymarket is giving 70% odds of being passed. And there was recently an interview that I couldn't believe. America is now the crypto capital of the world. CFTC, SILIG says digital asset rules taking shape. So this is all happening in the background. These rails are all happening in the background. Since Trump was elected, stablecoins have gone from 150 billion to 300 billion, but the predictions are that they're going to run into the trillions. Everyone expects this stuff to happen overnight. They expect Bitcoin to be the base layer overnight. Stuff doesn't happen overnight. This stuff happens over years, decades, right? But this podcast, this guy Patrick Witt is from the White House. It's only had 3,500 views, and he basically outlines where they're at with all the crypto regulation. This is going to happen. If you listen to this guy's language, it's going to happen. What are your thoughts? What are your views on stable coins, how the government is going to use them, and then how that ultimately is going to be bullish for the Bitcoin price?
It's such a huge topic, Mark, and I don't even know how to begin to unpack it, right? So can I have 2 minutes to run two thoughts in parallel, and then I'll come to a point, and then we can explain how to take advantage of it. So number one, why did Trump move on Venezuela earlier in the year and snatch Maduro and take control of, one of the world's largest oil reserves? Now, granted, their oil is quite heavy, which means it requires a lot of refinement, but nonetheless, it's still one of the world's largest natural proven reserves of oil,
If not the largest.
if not the largest. And then you've got now the move on Iran is to cut off China, who has been getting a whole bunch of oil from Iran and Venezuela on the cheap, which has allowed them to power and grow their economy in a massive way, right? Because you need energy to grow your economy. Unfortunately, the West have missed that memo and have come out with a bunch of anti-growth green policies. But
You might have seen my post recently on Instagram about this.
I gotta let it. I did see it. I did. That's which triggered my thoughts. But I'm gonna let it go because this is not a political conversation. In terms of how they've gone about choking China from cheap oil. Why would they do that? On what premise are they doing that? One, they need to ensure that China ceases its incessant gold buying program, because China has been dumping US treasuries like no tomorrow and buying up gold. And of course, they've got massive growth in they're still able to sell real goods, and they sell those real goods, dump US treasuries and buy gold, right? Now, what this does is it puts a lot of pressure on Trump's refinancing plans of, having cheaper interest rates or lower interest rates and good demand for US treasuries that doesn't require the Federal Reserve stepping in and printing a boatload of currency to buy long-dated treasuries.
His reborrowing plan in order to reindustrialize the USA, build back its military might and its production capacity so that it can have a healthier nation at home and not rely on China for all its goods, right? You've seen that.
Correct. And so part of that strategy is to ensure that China is now going to resume its US Treasury buying program, because that has, China's rate of dropping US Treasuries has been incessant. It hasn't slowed down. So that's number one. Then number two, the second parallel that I want to take everybody on, which was the topic of stablecoins. Why are stablecoins being co-opted into the US Treasury's strategy? Why is stablecoins being co-opted as part of financial infrastructure? Is because they are large natural buyers of US Treasuries and US Treasury bills. So how do they collateralize their stablecoin? It's not just by having $1 sitting in a bank and then it's representing one USDT or one USDC. It's cash or cash equivalents, and treasuries and treasury bills are seen as cash equivalents. And what they do is that they go out, and it's a massively profitable business. Like, that's why you see so many stablecoin competitors going out there and new stablecoins being issued, because the yield does not go to the end user. You don't have USDT yield. What you have to get it through DeFi protocols or trading or whatever it is, but there's no native USDT yield. What happens is that Tether, for example.
So USDT?
Yeah, so USDT, so the administrator of, or the manager and the issuer of USDT is a company known as Tether. Let's say they receive 1 million USD wire transfer. They will then create 1 million USDT tokens. They then go get shipped to the recipient's wallet address. And that's how Tether is essentially created. But they're not going to just sit with 1 million USD in a bank account. They'll go and take that 1 million US dollars and go out and buy treasuries. Those treasuries have a 4% yield at the moment, 4.3% yield, and they capture that yield as profit, right? They've got 90 employees, but billions of dollars worth of profit. It's a money-making machine.
I think they are the most profitable most profitable business per employee that exists at the moment, something like that.
Yep, that's correct. And they're also the according to my last look at the data, the 8th largest buyer of treasuries, right? Right, 8th largest buyer of treasuries. That cannot be understated. It's behind large sovereigns like Japan and Switzerland and all that.
So to put that into practical terms, they are the 8th largest lender of short-term money to the US government.
Yep. And that also helps suppress yields as well, because if you're buying up bonds at a rapid rate, it caps yields a little bit, because then that way there's supply demand. So we're now got these two parallel tracks, which leads towards why I think that Bitcoin crypto is going to be here to stay, and in a really big way, and it's kind of been co-opted by the US as a part of its treasury management strategy. Is that we have seen that they've gone towards Venezuela and Iran and hit them hard in order to strangle China's access to cheap oil. And then when that happens, there's going to be some pressure at home. And then in China's backyard, they're going to go and say, look, if you want the oil to flow again, you need to stop buying up gold and you need to buy US treasuries, number one. And then number two, they've got to be co-opting stablecoins into their treasury apparatus in order to have two massive buyers of US debt, China and the stablecoin issuers. When you combine those together, it allows you to go and reindustrialize your nation, take on very aggressive currency printing measures in order to pump the system with liquidity, which sends the stock market higher, which would send Bitcoin higher, in order to then look like you're, fast growing nation. Because $39 trillion worth of debt, which is where they're sitting right now, a third of it needing to get refinanced at current rates, is not sustainable. So they're going to do whatever they can. And the military action we've seen in Venezuela and Iran is that statement being put into practice, doing whatever they can in order to drive rates lower. So they're willing to have short-term pain. They've demonstrated that with their tariff actions in 2025. They're willing to take on short-term pain for what they see as long-term gain. So by having China come to the table, buying up US debt, you've got the stable coins being soaked up by the US Treasury apparatus, therefore buying up US debt. That means that you can now refinance your debt at more manageable levels because you've got more natural buyers of your debt in the first place. And then you can refinance at much better levels. You reindustrialize your nation. And, that's essentially what's at play at the moment. Now, there is a lot of speculation and conjecture in that, but I'm just inferring what's happening based off rhetoric coming straight from the US and also what we're seeing in real world at the moment. So there is some conjecture there is some speculation, but it's also what we're seeing in the world at the moment.
Please, guys, go watch the podcast that I popped up, Crypto Policy, Stablecoins and the Future of Finance, with Patrick Witt, a White House correspondent. He lays it out very clearly to the it was an Economic Club of New York lunch. Again, the videos only had 3,500 views. This stuff is happening. It's almost gone past the point of conjecture. Now, whether the US is going to be successful in rolling this out and forcing adoption, that question is yet to be answered. But whether or not this is a strategy of the current administration, well, that's not even a question anymore. It 100% is a strategy of the current administration. This guy, Patrick, was basically saying that he gets lots and lots of calls from other countries, foreign nations, banks and other countries saying, hey, how is this going to affect us, right? Because if you go around these countries and you ask the citizens, where would you want your money? Do you want your money in a Mexican peso, or do you want your money in an Egyptian lira or an Iranian or Turkish lira? Or do you want your money in something more stable like the US dollar? These people in the street are going to tell you, give me US dollars. They don't want their own currency. They want USD. What these stable coins allow is every single person to have US dollars on their phone. Very, very simply. And this Patrick Witz was basically saying that it becomes easier for the US government and the Federal Reserve, etc., to extend swap lines and things like that out to these countries if they're willing to adopt these stable coins, right? The US will provide all sorts of concessions to other countries where they'll provide them US dollar liquidity to adopt it. And if you've listened to Putin's representatives or Xi's representatives, this, in my opinion, is the largest existential crisis for them. right? And this is why I think you're seeing this whole gold play at the moment. I think you could go as far as saying that the US government, while they own a lot of gold and gold going up is also good for them, their weapon of choice is Bitcoin and stable coins. But they've got to do it slowly enough that it doesn't create havoc, right? But you're almost seeing like a bit of a power play at the moment. China and the Eastern Bloc are trying to make gold that global reserve currency. The US is trying to make it Bitcoin, you could say, although they're not being explicit about it. But it will take time. So I mean, I think it's extremely fascinating. And you only have to look at the price of Circle, which is the second biggest issuer of USD stablecoins. It's doubled from $60 to $115, $120 since November, December, since it was becoming clearer that these stablecoin acts, the Genius Act, the Clarity Act, was going to pass.
Now, if we look at the correlation that you were just pointing out to me off air with regards to how Bitcoin is now correlated or has a slight positive correlation with the US dollar, confirms to us this theory that stablecoins are no longer just this, spending apparatus that's kind of crypto native. It's actually part of the whole Treasury, U.S. Treasury's management of the refinancing that they have to go through in 2026. So it's crazy to see what we're dealing with, which is when we see oil go up and U.S. dollars go up and yields go up, Bitcoin goes up. Historically, these are events or market drivers that would have driven Bitcoin down. But we saw oil rip, we saw yields rip, we saw a flight towards US dollars, and then now Bitcoin's up. So these things do not operate in a vacuum. Whilst we could anticipate lower, I think that when you see all of that happening all at once, confirms to me that probably the worst of the selling has now resolved itself, and we're probably due for a substantial move to the upside. I'm not saying all-time highs. We're not in that territory yet where we can confirm that we're in a raging bull market, but these early signs of Bitcoin's strength in the face of war and correlating with the US dollars as a bit of a safe haven confirms to me that the worst is behind us, and now is a really safe territory to be buying Bitcoin.
Yeah, this is what I was showing you. This is data from Hedgeye, who I subscribe to. They're brilliant. I might talk about them in future episodes a little bit more, but you can basically see that there's a short-term correlation forming with Bitcoin and USD. And most people have the opinion that if the US dollar is going down, that Bitcoin is going up. But I think that there's a future and there's a world that we could move into where the US dollar is strengthening versus other currencies, and Bitcoin is strengthening with it, right? And you can see at the moment that if you look at these correlations, the US dollar versus oil and commodities, it is correlated. So the higher the number in green, 1 is a perfect correlation, and then negative 7.4 is a negative correlation. And you can see that gold doesn't have that correlation to the USD. So at the moment, and these correlations can always change, as you can see, but at the moment, Bitcoin, USD, and oil are all being seen as like a pro-US US dollar trade. So I think that's quite interesting.
Absolutely. And I mean, like the way I see things moving forward is that, Bitcoin was always meant to be a US dollar alternative, and was always meant to be the liberator of, the unbanked, and was going to be the way that Bitcoin can replace the USD. But, based off what I'm seeing now, based off what I can see now, is that Bitcoin becomes the world's global reserve asset, and the US dollar retains its global reserve currency status via stablecoins. I think US treasuries will lose global reserve asset status and will be replaced by Bitcoin as that, safe haven proxy. And particularly as if people want to get exposure to US strength, right? What's the easiest way you can get access to that? And you see the crypto complex booming eventually because of this. And of course, what you said and what you touched on previously cannot be understated, which is gold being seen as a BRICS and Eastern Bloc play on what the future of global reserve asset status should be, and Bitcoin being the United States' play on what the global reserve asset status should be, and that there's this bifurcation between East versus West, which is almost gold versus Bitcoin. Not that I'm against gold in any way. I'm very pro precious metals, but I'm pro Bitcoin as well. So it's just about when you're constructing a portfolio, which is why I love the name of the show, Money Markets and Mayhem, right? That's what you have to be exposed to actually be successful here is have Bitcoin in your portfolio, have gold, have some stable coins knocking about so that you can buy dips when they present themselves and be liquid. And that's what we're focusing on right now. You cannot put a price on freedom and liquidity, which is what Bitcoin and gold and stables will provide for you.
Yeah, I couldn't agree with you more. I think the US is officially the largest gold holder in the world, I think, and their gold is valued at $42 an ounce and hasn't been re-rated. So the minute that they re-rate that gold, so if gold gets to $10,000 an ounce, they can re-rate that gold, and that'll put something like $2.5 trillion into their treasury. So I think in a world where gold becomes the reserve, the global reserve asset, USA is still there, right? They're still there, and they're still going to compete in that kind of world. But I think behind closed doors, if you said which do you prefer as the global reserve asset, and you'll never hear anyone say this publicly at this point in time, I don't believe, it just wouldn't happen. But I honestly think that they would prefer Bitcoin to be that global reserve asset, and the reason being is because it's synchronicity or its alignment with stable coins. And what we just discussed earlier, that what's most important to them is not to have the global reserve asset, but to have the global reserve currency, right? They want all payments to be going through the USD. And I think that is their grand plan and their grand strategy.
All right, so let's break down the game theory of what the United States administration and treasury is currently doing. So you've got, over here a bit of a quadrant, which is not owning gold and not owning Bitcoin, owning only Bitcoin and no gold. Over here, owning both Bitcoin and gold, and then down on the bottom, which is owning gold and no Bitcoin. Now, people are placing their bets as to what future is going to be happening, and the China and the Eastern Bloc is more focused on owning gold and no Bitcoin and making a play towards, that precious metal dominating global trade. The Americans, however, have the added benefit of having, the U.S. Treasury owning an absolute boatload of gold. The government that holds the most gold is the U.S. government, and Donald Trump has come out and put out on Truth Social a post which was quite interesting. He who owns the gold writes the rules, right? And
say that again.
He who owns the gold writes the rules, right? So they own a lot of gold, right? They've got a proven Bitcoin reserve, right? However, they haven't added to it through open market purchasing.
But just sorry, can I just interrupt there with the Bitcoin reserve just quickly, because a lot of people have been a bit deflated that the government didn't come out and start buying Bitcoin. The US government can't buy Bitcoin in a way that means they have to raise debt in order to buy Bitcoin. They just can't. It's against their constitution or Congress or rules or whatever. But you've seen the US government take a stake in Intel. You've seen the government take a stake in Mountain Pass Mines, rare earth miner. We have Strategy, who own nearly 700,000 Bitcoin, nearly 10% of the total supply. Is it 10%? How's my math?
No, 3.5.
3.5, sorry. Who's probably trying to get to 5-10% of the total supply. Consider that property of the US government if it really needs to be, right?
Yeah, correct.
Just like before they start confiscating off private citizens, which they did with gold back 100 years ago, they're likely, they likely go after a company that nationalize it, right? So the US government doesn't need to really fill that strategic Bitcoin reserve to have access to Bitcoin.
Correct. And so, which is why I believe a big portion of why Saylor has been so rampant in purchasing as much Bitcoin as possible and couldn't care less about the execution.
He's been tapped on the shoulder to do so.
Yeah. And so, good on him, but we'll see what happens. Now, in terms of how it all works out, then you've got on the other side, which is owning only Bitcoin and no gold, which is, the common Bitcoin bros perception of the way you should be. And then at the other end, which is the most net negative approach that you can have, is owning no Bitcoin and owning no gold.
What are you even doing?
What are you even doing? You're just destined for poverty. You're gonna be eating cardboard for the rest of your days. These are
the property brokers.
Yeah, good luck, mate. We'll see what happens. But in terms of how it all works out, it's like you can play that game theory yourself. And I think that the most net positive strategic decision that you can make as an investor, this is where you can put actionable insights into your portfolio, is owning both Bitcoin and gold. Now, how you express that position could be done any different ways. You should probably give Stormbreaker a call and we can help you buy your Bitcoin. We can also help you
Throw the link down below.
of course, we can get your Pax Gold, but you might want to buy physical gold and you might visit a bullion dealer to do that. So there's many ways you can express that position, but I think the most toxic and negative position is owning neither Bitcoin nor gold, and the most net benefit position you can be in, which is hedging your bets in the most possible best possible manner, is owning both Bitcoin and gold. And so for me, I keep it simple, man. Like I just follow where the money goes, and then the markets does the rest, and then sit back, have a nice stogie with my brokers after a long working week on the trading floor, knowing that my assets are doing most of the heavy lifting for me.
So a question that I constantly get asked is, Mark, who do you use to buy your Bitcoin and your crypto? What exchange, what brokerage, what platform, etc.? For me, the answer is really simple. It's a company called Stormbreaker. They're located here in Australia on our shores, operating their offices out of Melbourne. They have over 40 staff with a team of dedicated brokers that can assist you anytime you like. I've got my own broker that I've got on speed dial, and anytime I need to place a bid or get a market update, I just give him a call. You can set up all kinds of accounts, self-managed super funds, trusts, corporate, or even individual. You can have as many accounts as you want. And if you mention the team at Money Markets and Mayhem, they'll set you up same day. So if you want more information, go to www.stormrake.com/MDP. Mention me, and you'll also get a free consultation with a broker, and you'll get a discounted rate on your trading fees. So it's www.stormrake.com/MDP. Enjoy the rest of the show, guys. My friend, I have to commend you, and I have to just say how much respect I have for you. You're a crypto brokerage, and a lot of people in the crypto space can be dogmatic about only promoting Bitcoin, but you have just, what makes that outline that you've just given even more special is that background information. But that's probably one of the most succinct ways that I've heard it being explained about the importance of owning gold and Bitcoin. And yeah, we'll get that quadrant put up in post for sure. But that there needs to be replayed and listened to again, in my opinion. Right? That is, you have to have a call option on these futures, right? You don't even have to go out and study history to have that call option, right? Not to be on zero, I think is just crazy at this point, after we've seen everything that's unfolded in the last 12 to 18 months.
I agree. And I think that there's so many positive ways that we can actually build each other up as well. Because we've talked about oil, game theory, statecraft, there's these really big, large macro topics. And it's like, how do we distill that into something that's more actionable for the individual who's dropping their kids off to school in the morning and then, on their way to work, there's this AI existential crisis going on. Am I going to become replaced? And then the blue collar guys are going, see, I told you I can work with my hands. And, they're actually having the last laugh at the moment. So, there's so many things that are causing stress and anxiety for everyday Australians. And we kind of, took a shot at Australian property, which is where most Aussies store their wealth. So it can seem like it's doom, doom, doom. But I have 3 children. You've got kids. I've got a wife. You've got a missus. You've got people who you're responsible for, right? There's actual genuine solutions available, but it just requires taking on some risk. And so for me, managing risk and taking on risk is part of how you can become truly financially free. Because if you want risk-free, you just sit in Aussie dollars. You do nothing. You work for your weekly paycheck or your monthly paycheck. You put some food on the table, but you never get ahead. And but that's also in and of itself a form of risk, which is your one, health incident away from no longer being able to provide for your family. So you need to choose what type of risk you're going to take, because not investing is a risk. Investing is a risk, but knowing how to manage it and knowing what you want to do in certain scenarios, which is what I love about how you approach financial markets and why I think you've got such amazing and informed listeners, is not because you are making bold claims and predictions, but you're weighing it on a probability basis, and you've got scenarios where you manage your risk depending on what happens. And that's, for me, all I've ever wanted for my investors. I say this as somebody who manages 10,000 clients. I've got $500 million worth of assets under management and growing into the United States. I just want informed investors who are not making rushed emotional decisions and just ones that are grounded in rationality. So that if the market goes to 100,000, we don't have a bunch of people now buying back in and after selling it at 65. It's like, no, we should be buying in the 65s, leaving some capital on the side. And if we run to 70, or we have a thesis that, for me, I'm going to become a mega bull as long as we reclaim the 200 EMA. That, for me, from a technical perspective, and alongside all the correlations and the positive recent fundamental development that we've seen in the market, for me, confirms fundamentals and technicals are now married. Macro gives me the green light, go ahead, can become a mega bull again. Until that happens, I'm still buying, but not with a full clip basis, because the technicals haven't quite married up to what's happening fundamentally and from a macro perspective.
I think that a lot of especially my listeners, because I've spoken to a lot of them through comments and DMs recently as well, now understand the need to get off zero, and I think most of the people that I speak to have already gotten off zero, and so we're doing the best we can to try and bring that message to more and more people. Let's get into what we think is going to happen with Bitcoin over the coming month, 3 months, 6 months. You mentioned the 200-week EMA. Give the listeners a definition of what that means and where is that price, and then I'll throw up some charts and show you what I think as well.
Yeah, so an EMA is an exponential moving average. It's a useful barometer of long-term trend. A 200 weeks is a long period of time where trading has occurred. And historically, if we're above the 200-week EMA, it shows that we are in a bull market. If we're below the 200-week EMA, we are in a bear market. And that's a really positive indication of where a useful tool to confirm for you which regime we're in. Are we in a bear market? You trade differently and manage your assets differently in a bear market than you do in a bull market, because bear markets are for buying, bull markets are for enjoying your newfound wealth, right? Because a lot of the time people flip the script. So that's essentially a useful technical indicator, which you shouldn't base your entire thesis on, because technicals are a lagging indicator in and of itself, but you combine technicals to help you refine your entries alongside and supporting your wider fundamental and macro thesis. So that's what the 200-week EMA is.
Do you know where would it cross bullish? Do you know roughly where that price is at the moment?
Currently
82,000. Okay, let's get into some charts, or let's get into some things that I think are going to happen, and you can say yes, no, I agree with you, or I don't, and why. All right, so yeah, we spoke about correlations earlier, and again, courtesy of HedgeEye. I've spoken about this before, the macro quadrant. So you've got 4 quadrants in macro. You've got basically the summer, or quad 1. That's when growth is accelerating, and GDP growth is accelerating, and inflation is decelerating. So that is kind of like the best environments, kind of Goldilocks. You've got quad 2, where growth and inflation are accelerating. You've got quad 3, and that is where growth is slowing and inflation is accelerating. And you've got quad 4, where growth and inflation are both decelerating. And at the moment, HedgeEye thinks that March is going to be a quad 3. And if you look at the back tests for Ethereum and for Bitcoin, they back test very, very well in those quads, right? Whereas the broader crypto market doesn't do very well in quad 3. So at the moment, for me, I'm thinking that the month of March could be bullish. What are your thoughts?
Yeah, look, you have to take what I'm about to say with a grain of salt, because I am a perennial bull. But yeah, I think that March should give us some sense of a relief rally. We have to keep in mind that we've had 5 months, bro, of absolute bloodletting, right? The last time we saw 5 brutal red months was in 2018. So again, I'm being cognizant not to call for a new bull market and that we're ripping to 150 right now, but I think we are well overdue for a substantial relief rally. I just don't want people buying into the relief rally when it happens, right? Because if you buy, the local relief rally top in the mid 80s, then you're not really doing much of yourself a disservice. You're not helping your portfolio all that much by bringing your average acquisition price down, particularly if you bought a lot higher in the high 110s or 120s, right? So for me, buying at these levels under the 70K handle, closer to 65, is a fantastic way to take advantage of what I believe will be a substantial relief rally. I just don't feel comfortable necessarily pulling the trigger when we're at 85, 90K, which is where a relief rally can take us to. And then people now get really bullish again. And then we get a retest of the mid 60s, and then people say it's going to 40, and then we really truly kick off at that stage. Because we can go back to 2022. We had that sell-off in June that took us down to 15,000, relief rally back up to 24,000, which was substantial. Then we went back down to 15 before we ripped up to $126,000 over 2 years. So I don't want people to get chopped up in the bear market volatility and buy higher in the bear market range than when they could at the low end of the bear market range, because I believe we're forming a bottom right now. We could retest the 60s, the low 60s, or the mid 50s. Definitely, I'm not ruling it out, but right now we are in that bottoming zone, which was similar to what we had seen from June of 2022 till December of 2022, where we traded from a low of 15,000 to a high of 24,000. That was the range that was set as we bottomed out. I think that for me, 60 to 70 is going to be the same as 15 to 24, historically speaking.
So I think it's important to note that you can have multiple strategies when it comes to Bitcoin. You can have one account. So I have one account that is my HODL Bitcoin that'll never, ever be sold. I have another account that is my DCA. Every month, same amount goes in every month, and I try and pick the best possible entry points within that month. Like 65 recently was an entry point, not 74 where it's failed, or 72 where it's failed. So if you can try and pick those, even better. But if not, fine. You just every month on the same day, whatever it is, you DCA. And then I have another strategy where it's like back up the truck strategy. That's where I have like limit orders set with my broker at Stormbreaker, that if Bitcoin hits 60 or 59 or 55 or 45 or 35, the bids are already set, where there's going to be larger amounts of capital going in and buying, regardless of what the news is, regardless of Bitcoin being dead or whatever it is. The prices get hit, the bids get met, right? Like that's just, and so you don't have to look at Bitcoin or any asset as one dimensional. You can have separate strategies with separate accounts to try and make use of the volatility, right?
I love that, Mark. Seriously, that there is absolute gold. People need to rewatch and understand what you just said there, because even for myself, right, I've got a family trust in which I hold my Bitcoin, which is never going to be sold. It's never going to see daylight. It's probably just going to go towards my children, right? And they're going to be the wealthiest 18-year-olds known to mankind at that point, right? So that's that strategy. Then I've got an active trading account, which I don't even, show that to the public, because there's options in there, there's perps in there, there's spot positioning. I'm in most cases I'm not even trading directional long short. I took advantage of the Brent and crude oil spreads, right? Between WTI and Brent, there was a big spread difference, and I took advantage of that. This is stuff that just is not going to see daylight in terms of for the public, because it's moving at such a rapid rate. I've got multiple exchanges, multiple CFD brokers. I'm on Hyperliquid. I'm trading on multiple venues. Like, to offer that to the public would just be irresponsible, right? So then there's that strategy, right, which is my own personal trading account. Then I've got my own everyday Bitcoin account, which I use like a savings account. Sometimes I'm using it to transact. Sometimes my missus wants to get her hair and nails done and buy a new car, and so there's less Bitcoin in that account that particular month. So So there's different strategies for different purposes, right? There's Bitcoin as my savings account. There's Bitcoin as my trading account. There's Bitcoin as my HODL account. And that there is genuine gold and is worth its weight in whatever Satoshis or gold that you want to measure it by, because that's how you can become really profitable and also not stress yourself out based off whatever one account is doing with your portfolio, because you've got your HODL stack that you don't really care about, that you do care about, but is just there for the kids. You've got your trading account, you've got your medium-term investment account, and I can do that completely liquid 24/7, 365 without even having to ask the bank or anyone else for permission, because I'm completely free and sovereign as an individual.
For my mind, it's the only way to save you from getting chopped up. If all your decisions come into this one holding or basket of Bitcoin, you're going to be so emotionally distraught and you're going to get chopped up with price variations. But if you have those individual strategies, and you might not even be a trader, and you might just choose the one strategy, which is DCA, which is fine. But yeah, I think it's a great way. It's a great way to have more emotional control and more emotional resilience, because, say you've got $100,000 to invest and $50,000 is in your HODL Bitcoin and $40,000 you're DCAing. Well, maybe you're going degen with call options, right? Like for me, the next month or so, I'm bullish Bitcoin. So maybe I use 10,000 of that 100,000 to go long IBIT calls and to try and trade around the movements, right? But I think that's the best way to kind of sandbox your holdings, and it avoids mistakes and catastrophic selling all your Bitcoin and things like that.
Correct. And it's tax efficient as well. Like, again, I'm not giving tax advice because I'm not a licensed tax professional, but if you've got an account in which you're not having to worry about triggering tax events that's positive, and then you get to take advantage of those long-term holding capital gains discounts. Then you've got a trading vehicle, which might be a PTY LTD, which is capped at, 33% tax in terms of, so what your tax obligations will be. So there's so many ways you can do it. And obviously speak to your accountant to get proper licensed tax advice, but it's emotionally manageable. It's tax optimized, and it's a far more efficient and scalable way to invest across multiple accounts. And that way you're not having to constantly chase the latest move and then make a rash decision, because I've got clients of mine who trade in their self-managed super fund very differently from how they trade in their PTY LTD, right? Their self-managed super fund, they come in, they buy every month with whatever income they've got from their employer has put in. And then their PTY LTD, it's got all kinds of just like degen trades going on, which is cool because it's isolating. You don't want your SMSF, the future of your retirement or for yourself or children, to be dusted trading, high leveraged positions or highly risky positions.
I've been there.
But then you go out there and you've got the appropriate vehicle to express risk, because it's, again, we go back to what we were talking about before. How are you going to manage that risk? Because risk is inevitable. You put on your seatbelt, you reverse out of the driveway, there's risk, right? You're on the roads. You cross the road as a pedestrian, you don't look both ways, there's risk, right? So there is no way to avoid risk. It's just how do you manage it to optimize for your lifestyle and for what you're trying to achieve.
Yeah, I agree. And something that we got great feedback on last time was the receipts. So I reckon we can end it with the receipts. We'll do a little bit of a grading on how we went last time, and we'll set it up for what we think happens next. So can you see that, Bisher?
Absolutely.
All right. So we said episode 1, 60 to 62 would be the first floor, and it will bounce. It tested twice and it's bounced both times, so that's happened. We said 75 to 80 bounces, likely trap. So this is what you were saying before, that you're going to see a bit of a relief rally. So we've rejected at 74 on the first time. We haven't gone higher than that yet, but March could be that month where it goes higher. I said that 200 companies of Bitcoin treasuries could become forced sellers, and you've just recently seen Mara, the largest Bitcoin miner, has, in their recent filings, has authorized 53,822 Bitcoin to be authorized for sale. So they've basically indicated to their shareholders that this is now eligible to be sold. I think they've sold like 4,000 or 5,000 Bitcoin. So this thesis could still unfold.
You didn't include BitDeer in that one.
Yeah, there's a few others in there, but Mara's
was a company that became known as they're a mining operation, but they sold all their Bitcoin treasury. Bang, gone.
unbelievable. Yeah,
See you
I mean,
later.
still could happen. And we said zero probability of going from 60 straight to 100K. Bisher, I think you've echoed that as well today. Correct. It's still stuck at 70. So we're 5 for 5 on the initial thesis. The updated takes. So again, the levels that matter, and you've mentioned it, is a 65, which is the fib retracement, the 200-week moving average, the floor of that, 58, hasn't been tested. So a quick whoosh down would be a gift for us guys that have got bids set at 59 and things like that. And this is like worst case scenario, 35 to 45, which is I'm actually giving that less probability. So I put all the information into Claude, and I get Claude to decide on the probabilities. I put the information in, get Claude to decide on just these probabilities. And they're basically now upping the probability from last time, for I think it was 30% to now 40% that we've seen the worst. And it's a 60, 70K base. All right. So that's interesting as well.
Probably where like I have a slight divergence in terms of, I agree with you on almost all of it. I just think we've seen the probability of having us seen the worst is probably a lot higher, like in the sense that we're probably closer to like a 60 or 70% probability that we've seen the worst behind us. Doesn't mean that it's a guaranteed shoe-in now, but I think that the 60 to 70K base is as good as it's going to get. Of course, things can get updated, and obviously the receipts will prove otherwise, but I think we have genuinely seen the worst behind us, and we may get like a low sweep of the mid-50s, but it won't live there for a very long time, and we'll go back to that 60, 70K base.
I'm starting to feel like that could be the case, and the thing that's changed, or if we have seen the worst, in my mind, the thing that would have changed that did not allow us to retest would be the thing that's happening in Iran. And if all these things are going on and people need to try and get out of certain currencies, or even in the GCC nations, United Arab Emirates, Dubai, etc., if people have to leave these countries in a hurry and they can't take ounces and ounces of gold with them on the person,
can't take their real estate. Dubai
right?
Real estate gotten absolutely shellacked.
Right. If you can't take your Dubai real estate with you, I think what you might be seeing at the moment is some liquidation of assets into Bitcoin. And that's the one thing that I think could change the thesis. And we'll see, like time will let us know in the next couple of weeks whether that happens. And Bitcoin might have seen its bottom. The other thing is the Coinbase premium has flipped positive. So that means institutions nibbling. You've seen the Mara, that thesis, that could be, and you've seen Bitcoin still largely being correlated to USD at the moment. So, but one thing to keep in mind is, even though it's 40% that the bottom's in and you're saying 60%, there's still 30% scenario DAT treasuries unwind and 30% scenario emergency print. That's becoming more of a possibility with the war that the US has to print. And so we're still saying, or Claude is still saying, is giving a 60% probability that we go lower, 40% that the floor is in. But the most important thing, and I think we keep talking about this, the floor is getting closer, might not be here, might be here. But what it means, scale in, don't scale in, don't go all in. Keep DCAing into fear, not the bounces. Don't DCA when we wick up to 75, DCA when we wick down to 68 or 65, right?
63 on the Saturday.
63 on Saturday, right? And you can have, this is one of the things I love about working with you guys. You can just have your bids set, and you can update those bids. You give someone a call, up those bids if you need to. So, the best prices are built, not timed. Just have those bids set, survive the drawdown, capture the upside. What do you think about that?
Pretty much, I'm all on that. Pretty much, I'm probably 60, 20, 20 in probabilities, but pretty much 100% aligned on that viewpoint. I would say that if the war continues to get more and more protracted and there's a deeper conflict, and we saw recently a Thai oil tanker try to move its way through the Strait of Hormuz, and then bang, the Iranians went after it. And so that kind of shows their resolve in this conflict. When you see the escalations in the war, and again, I just want to preface, when I talk about war and I'm just purely looking at it from a financial markets perspective, it's not to minimize the loss of life that's happening in that part of the world. It's just I'm looking at it from what's relevant to me and my profession.
I need to give that preface a lot more, I think, because people could get fooled into thinking I don't care, but we're only trying to speak of it through the lens of macro and investing. It's a whole other podcast to talk about the humanitarian and the moral.
Absolutely. I mean, my family's from Beirut, which is currently copying it right now. So, I know how real it is, but I just try to focus on where I can provide value to my investors. Now, in terms of what I'm seeing is that when these escalations unfold and you're seeing oil kind of whipping around and, they're now planning on wanting to mine the Strait of Hormuz, and then you've got on the Yemeni side, which is on the Strait of Aden, Bab el-Mandeb is what it's known, is that there's potentially 2 oil choke points. So you can't get out of the Suez Canal and you can't get out of the Strait of Hormuz, and that's going to affect, of course, to a quarter of all oil supply kind of goes through those 2 straits. And so if that escalation continues and oil continues to rip higher and US dollar continues to rip higher and Bitcoin rips higher in tandem, then that completely changes the macro landscape. So that's something that we should be watching. If we obviously get those escalations and Bitcoin goes down, then we're still wearing a risk on. We're still a high beta risk on asset, right? So we have to let the macro regime dictate to us how we trade and invest in this asset. If we head higher with oil and US dollars, that's something that needs to be watched quite closely.
Couldn't agree more. And we're pretty much scheduled to have you on once a month to discuss macro. But if we see those things changing in real time, and we believe that there's a need to have an emergency pod, we will have an emergency pod to discuss those things, right? You got to be a little bit Bayesian in your approach, and that basically means when the facts change, you have to change with them. And so with that, this is what we're trying to bring you guys. We're monitoring this stuff in real time, so you don't have
Monitoring the situation.
We're monitoring the situation. So hopefully you don't have to as much, because it is time consuming to watch the podcasts, to look at the charts.
Funny meme on X the other day, which is like, man was not meant to monitor this many situations.
There's too many situations to monitor at the moment, like,
yeah.
I don't know, like sometimes I think, let's not try and get it too perfect and just keep it simpler,
Yeah. It's good. But that's what people come to us for, they come to us for the bold predictions. And what I love about these bold predictions is that we've got the receipts, baby. So you can come at me all you like and on the fact that I'm a Bitcoin bull, but I'm a measured Bitcoin bull. I'm not going like crazy in a China shop at the moment and just going all hell breaks loose and calling for new tops. I think that this is it's actually a better risk adjusted place to be a Bitcoin bull than when we were at 120. You know what I mean? It's far better to be a Bitcoin bull at 65, 70 than it is to be a Bitcoin bull at 110, 120. So 100 more bullish as price goes down.
100%, mate. That's why I took this off the wall today and put it here just for you, right? Because you're a level-headed bull. Where can the people get in touch with you if they want to reach out to you and have a chat?
Link in the show notes, stormbreaker.com/MDP. And you can also book a consultation with myself. Just give Mark a shout out and say that you came to us through Money Markets and Mayhem to get the 2% brokerage rate locked in. Otherwise, you're going to be on the house rate of 3%.
All right, brilliant, mate. Look, if you don't get a lot of calls, I'd be extremely surprised. Like, now is the time that people need to be picking up the phone and inquiring into this. Don't wait till it goes back up to 125, because as we've seen, things can change overnight. Oil went from $67 to $120. It doubled in a week.
Doubled in a week, mate. This is one of the world's most important, if not the most important, energy asset on the planet. Doubled in a week. And you would say that if that happened previously and Bitcoin was trading at 70, after sitting at 62 on the onset of the war. Like, you have to change based off what the market gives you.
We didn't even touch on the fact that AI and agentic AI and 24/7 agents are not going to be able to run on anything but crypto. And when that eventually takes hold, right? Like, we haven't even touched on that. We'll save that for next episode.
Yeah, that's a whole category. We've got a 30-man and woman team here at Stormbreaker, but we are operating like we're 120 thanks to agentic. Like, it's honestly, it's crazy. Like, I have it dropping in reports to me every morning. It's writing for me articles. It's giving me insights. It's honestly insane. It took a big leap up in February for sure.
All right, my friend. Thank you for adding so much value.
Cheers, my friend. Anytime.
See you soon.
Still here, can't be bought, forged from fire.
This ain't a flex. It's a war on your capital, your time, and your mind. Mayhem in motion, that's the open bell. Markets run red while the headlines sell. They hedge the crash while you chase the climb. Smiling on screens while they buy your time. The algorithms don't fade, it was people fade. Every tap's a contract, every post is played. You ain't broke cause you're weak, you was born into theft. A system that profits when there's nothing left. This ain't fall flash, I'm stacking the last. Protecting my blood from a digital past. Bitcoin ain't hype, it's defense by design. A firewall built for the family line.
There's fire in the wire, smoke in the street. We spin the wheel while we grind to eat. But I keep my holds clean, my cold tight. Stack around solid while they chase likes.
They sell you status, but the price is steep. Your clicks are currency they never keep. You scroll for hope, but the screen's a mask. Designed for dopamine and corporate grabs. No trend chasing, I chart my course. Don't ride waves, I study the source. Truth lives quiet in the cracks and codes. And silent legends where real ones load. This ain't for the gram, it's war prep tech. Resilient minds cashing out of the wreck. Indestructible roots forged deep through flame. I'm building my exit from a rigged old game.
There's fire in the wire, smoke in the street. We spin the wheel while we grind to eat. But I keep my holds clean, my cold tight. Stack a real falling while they chase lights. There's fire in the wire, smoke in the street. We spin the wheel while we grind to eat. But I keep my holds clean, my cold tight. Stack a real falling while they chase lights.
The chaos ain't loud, it moves like a ghost. Inside your habits, in every post. They sell mayhem, wrapped in design. But I see the rot in the bottom line. I don't just spend, I allocate. Every choice I make is a firewall gate. This ain't rebellion, it's math and steel. A normal mind with a sovereign will.
There's fire in the wires, smoke in the street. But I rise up, never miss a beat. I don't need hype, I move unseen. Forged from fire, in the sovereign dream.
Indestructible ain't loud, it's built in silence.